Do you lose money trading? Well, let's fix that. Welcome back to Hi-TeK ReDNeK Money, where we dive deep into the world of trading to bring you the best tips, strategies, and insights to make your trading journey successful. If you're new here, make sure to hit that subscribe button and ring the bell so you won't miss out on any of our content. Today, we're tackling a crucial topic that could make or break your trading career: effective risk management in trading. Grab your notebooks, because this is a guide you'll want to refer back to time and again. First up, let's talk about acceptable risk. Imagine you're about to embark on a thrilling adventure. You wouldn't set out without knowing your limits, right? In trading, the acceptable risk is that limit. It's the maximum amount of your capital you're prepared to lose on a single trade. Most seasoned traders stick to risking a small slice of their pie, typically between 1% and 2% of their trading capital per trade. Why? Because it keeps the game going, even after a string of losses. Let's break down what this looks like. If your trading account has $10,000, a 1% risk means you're only risking $100 on any given trade. This method ensures that a single loss, or even several, won't wipe out your account. Now, you might wonder how we enforce this rule. That's where stop-loss orders come into play. And stop-loss orders are your best defense against unexpected market moves. By setting a stop-loss, you're telling your broker to sell a security when it hits a certain price, effectively capping your potential loss. For instance, if you buy a stock at $50 and set your stop-loss at $48, you're limiting your potential loss to $2 per share. This automated guardian angel ensures you stick to your acceptable risk. But what about the flip side? How do we measure the potential gain against this risk? That's where the risk-reward ratio comes into play. Every trade involves weighing potential gain against potential loss. The risk-reward ratio helps us do just that, aiming to ensure that the potential upside of our trades significantly outweighs the risk. If you risk $2 in a trade that you stand to gain $4, your risk-reward ratio is 1 to 2. This means for every dollar risked, you aim to make 2. Savvy traders often look for opportunities with a risk-reward ratio of at least 1 to 2 or 1 to 3, balancing the scales in their favor over time. This way, if you win 50% of your trades, the wins will pay double what the losses lose, giving a net gain of 33%. With indicators and market knowledge, we would hope to have better than a 1-to-1 win-loss ratio, but we prepare for the worst. With our risks defined and our target set, how do we decide how much to invest in each trade? Let's dive into position sizing. Position sizing is the final piece of our risk management puzzle. It's about determining how much of a particular asset to buy or sell, ensuring we adhere to our pre-defined risk levels. Let's say you have a $10,000 account and you're comfortable risking 1%. Your dollar risk per trade is $100. If your stop loss on a $50 stock is $48, you're risking $2 per share. Divide your total risk by the risk per share, and voila, you can buy 50 shares. This method keeps your risk consistent across trades, regardless of the stock price or the size of your account. It's about making calculated decisions to protect your capital and maximize your potential for profit. And there you have it, a comprehensive guide to managing risk and trading. Remember, the goal isn't just to make profits, but to protect what you have and ensure you're in the game for the long haul. Implement these strategies and watch as your trading foundation becomes rock solid. And if you found this guide helpful, please give us a thumbs up, share with your fellow traders, and don't forget to subscribe for more insightful content. Have questions or want more in-depth tutorials, drop us a comment below. Until next time, keep trading smart and safe. Also, a quick channel update, I'm working on getting a website/blog up to tie all of the concepts and guides together, since YouTube is not always the best way to go in depth on complex ideas, so keep an eye out for that.